Okay, so this is what we're going to do for this evening. Forensic auditing, one, and then we will conclude the lecture with um, prospective financial information, PFI. But before we start with either forensic auditing or PFI, I want us to discuss the coverage for the examination. The semester is already distorted by the strike. The semester by itself is short, and then unfortunately, there was a strike action. We have to kind of be pragmatic, see what we can do, see the best we can do. This is our course outline. Okay, so this is a detailed section of our course outline. We have already done audit planning and risk assessment. Sorry. Okay, we have done audit planning and risk assessment. We have to do transaction cycles and related controls. So we may start that one tomorrow. Tomorrow we are going to meet. We also have to do audit evidence. Auditing in a computerized environment is actually part of audit evidence, just that it has some few technicalities because it involves computing and some technology stuff. So we're going to treat it together, audit evidence, including audits in a computerized environment. Yes, so I think this is where we have to, and probably, this is a probability, probably practice management. The reason is that we've done almost more than 50% of practice management stuff from last semester. So the last part, the concluding part, we just add it and it becomes examinable area. So these are the maximum areas. The rest will not come. So these are the areas in addition to what we have done or doing today that you should expect. Something on prospective financial information, we are going to do it today. Forensic auditing, we are doing it today. So what we are doing today, in addition to those ones I have just identified for you right now.
Hey,
Any comments? Yes,
then
madam.
please kindly go over the topics again.
Okay. Audit planning and risk assessment. That's the first thing on your course outline. That one is already treated. Then the second thing on your course outline is transaction cycles and related controls. We are here to do it. We will start it tomorrow. Audit evidence. We are here to do it. That is also part of what we should know. And the audit evidence will be taught together with auditing in computerized environment because it's actually together. We will not do week 7 and 8, which talks about the audit of specific items. We will not do does not mean you should not learn it. You have the textbook, so go and learn it. But it is not examinable. Practice management may be taught because I have taught more than 50% of this topic. So I may want to conclude it. If that is done, then it becomes part of the examinable topics. We are going to do prospective financial information today. It's examinable. Forensic auditing also today, examinable. That's all. That's the end. I may talk something about current issues and development in auditing, but anything I will talk will not be examinable. That doesn't mean it is nonsense, so don't come and listen. Any questions?
No question.
No question. Thank you. So let's come back to business. Forensic auditing. I think let me begin with, okay, doesn't matter. Let's begin with forensic auditing. We've all heard about forensic accounting. And whether I write it forensic auditing or forensic accounting is the same thing. Auditing is accounting. We've all heard of it before. So let's bring the backgrounds we have about this topic onto the table. It helps a lot in understanding. Then we look at the formal text. We try to explain the formal text. We already have the text already. So we are kind of doing some preview. What is your understanding of forensic auditing? It's a question open to all of us. Please be prepared to talk. We should consume this material in less than 2 hours, but it depends on your attitude. What's forensic auditing in your opinion? Abna Safo. Is Abna Safo in class?
Yes, sir.
Abna, if you're in class, please say something about forensic auditing. Just say what you understand. That's all. That's what we need.
Okay. It's an audit to detect crime or yes, sir.
Okay, that's
An
that's
audit
not bad.
that an audit
An
done
audit
to
to
detect
detect.
crime.
Okay, that detects crime. That's good. If you also want to add something, you can just mention your name and just speak. Okay, so let's look at the presentation material. This is on forensic accounting or forensic auditing. Just as she helped us to know, forensic auditing is not too different from the auditing you know already. It's just a kind of investigation which employs many of the techniques that auditing employs that we know already. But the investigation is related to fraud. That's the key feature about forensic auditing. The investigation, as opposed to normal investigation that we do in audit of historical financial statements. The auditor doesn't have that intention of catching a thief. He's not thinking of anybody doing a thief thing, stealing, doing fraud thing. No, that's not the mind of the auditor in traditional auditing. Just that he should come up with procedures that if these things are existing, it should expose. But that's not the official background with which the auditor goes to the companies to audit. But when it comes to forensic auditing, that is the background. That's what the auditor has in mind. That's what the auditor is going for, going to actually substantiate. So let me just quote some of these official definitions to kind of confirm what we are describing about forensic auditing. Forensic accounting refers to the whole process of investigating a financial matter involving fraudulent activities, including potentially acting as an expert witness in the law court if the fraud comes to trial. That's all the things inside forensic auditing. An investigation of a financial matter which involves fraud. It doesn't end with just the investigation side. The potential events that you will have to show that evidence you will gather from the investigation to the court. That's what forensic auditing is. Forensic auditing is not too different from the traditional auditing in terms of the structure, as I have already established. So this is the process that it normally goes through, very similar to the traditional audit. It has a planning phase, evidence gathering phase. So this should not be needed. Evidence gathering stage, review stage, and maybe a reporting stage, just the way we do normal audit. It's just that the focus is on finding evidence for crime, fraud in this case, and possibly tendering the evidence to the law courts. So let's talk about types of. Anyway, let me establish that forensic auditing, even though mainly employed in investigating fraud, it is also employed in other areas that are non-fraud, other non-fraud areas. For example, during process of, selling off a company, you sometimes get some disputes between um, shareholders of the company in terms of which values and which liabilities are attributable to which people. In such cases, you can employ forensic auditing techniques to kind of settle the disputes between them. It will just help us to know which liabilities or which assets belong to which person, clearly. Yes, but this is clearly a non-fraud investigation. So it's not only for fraud, just that most of the time um, we have cases of fraud as opposed to other cases. And that's why forensic auditing appears like it's a tool for only fraud investigation. That said, the rest of our discussion is going to focus on fraud, the fraud part of forensic auditing, even though forensic auditing can be used for other things. So types of fraud investigation. We need to know about types of fraud first, so that when you are preparing your investigation techniques, you can prepare the techniques, you can come up with a procedure such that you'll be able to get the correct evidence. So types of fraud. Three main categories of fraud if you read about this area. One is corruption, second one is asset misappropriation, and the third one is financial statement fraud. Three main. So let's look at corruption. Corruption is defined by what is inside corruption. And under corruption, we have three types. Conflict of interest, bribery, and extortion. It means that these terms are not synonymous to themselves, even though they might have some interrelatedness, they are different in total. So what is self-interest? As for self-interest, everybody knows because we have said so many things about self-interest for the whole of last semester. So I want to give the opportunity to you to actually be involved in the class. What is self-interest? Just speak your practical understanding of what it is. What is self-interest? Yes, you. Let me find the you I'm referring to. I just want to find something. Ahiadu, Tenge, Tenge, Mr. Tenge. Mr. Tenke, you just logged in and you are sleeping. Okay, let's give a chance to Alberta Dankwa. Alberta. Alberta. Alberta, we are waiting for you. Madam, you are not talking. Okay. This is forcing me to decide to take rule. If I mention your name, because you can't just log into the class and sleep. When you do that, you will cause me not to achieve my objective.
Hello, sir.
Alberta,
Yes, sir. Please, I was having network issues, so I couldn't hear you.
madam, okay, now you can hear me, I can hear you. And I think the whole class can hear you. So speak something about the question. What I
Please,
was
sir.
saying, what I
I
was
didn't
saying,
hear the call.
I'm saying it again.
Okay.
What I was saying was we were just discussing corruption as a type of fraud. Actually, three types of fraud: corruption, asset misappropriation, and financial statement fraud. We have come down to corruption as a type of fraud. And we define corruption by looking at what goes into corruption. Three types of fraud under corruption. Number one is self-interest. Sorry, number one is conflict of interest. Conflict of interest. And number two is what? Number two is bribery. And the counterpart, in fact, bribery and corruption are two sides of the same coin. We'll explain for you to understand how it is so. So I'm asking, we talked many things about conflict of interest, more in the form of self-interest during last semester's lectures. So you can borrow the idea from there and tell us what conflict of interest is. Because it's an everyday word, even without your knowledge in last semester's audits. Conflict of interest is a common word, and it doesn't mean so different from the ordinary usage of the word. I want you to say something about it. Rahima, we are waiting for you.
Hello.
Yes, please, you
Hello.
can talk. Yes, madam.
Okay. So, for example, a relative of mine is working under my authority, and then maybe he or she is not doing the work well, and she because of the relation I have with the person, I can't correct him or her to do it. Like, yeah, something like that.
Okay, so
So
that's a
this
practical
with this one,
explanation.
yeah.
Okay, good. So if you read a text that I'm presenting before you right now, conflict of interest is defined as a situation where the fraudster exerts his or her influence to achieve a personal gain. So it's actually a conflict between his personal gain and what the job demands. Conflict of interest. And an example is what you gave. You can also read the example I've given in the text. But we have to know that the conflict of interest may not yield a benefit to the fraudster himself or herself. it could be to a relative, it could be to a friend. All of them are still conflict of interest. Once the person gains some personal satisfaction, some personal achievement, something that satisfies what he wants, that's conflict of interest. Bribery is when money or something of value is offered in order to influence a situation. So bribery is more of when you are giving what will influence another person for you to get a favor or for you to get something to be done. So it's more like you initiate it and then you give something to influence the person to do it for you. Extortion. Extortion is the opposite. Extortion is the opposite of bribery. So extortion and bribery are like two sides of the same coin. So when we turn the other side of the coin, we see extortion. Extortion is where money is demanded by you rather than the person offering you money. So you personally demand the money from the person to do what the person demands. So it could be like what I mean is very common on campus. If a lecturer, for example, demands something from a student before the student gets what she's demanding. Actually, in in ordinary terms, that is just a transaction, not really a corruption. But in business, this thing is seen as a serious because actually you're not supposed to use that your position to profit personally. So in business, it might feature more in terms of taking money. When you request for money, so give me this then before I do it. So a student should come and pay you money before you change a grade. It normally happens with the TAs and we get the information. It's in our hands. That is an example of extortion. The TA personally and expressly demands from you to do what you want. The bribery would have been if the TA is offering something to get another part to do something that favors him. It's kind of they move in opposite direction. So that's what is inside the first type of fraud, which is corruption. These are the features of corruption. They come mainly in three forms: conflict of interest, bribery, and then extortion. Another type of fraud, which forensic auditing mostly will center on, is asset misappropriation. It's very common in businesses, mostly in small businesses, because small businesses happen to have very weak controls. And if perpetrators see these loopholes, they will begin to steal assets, assets misappropriation. Let's read about what I've put there. Actually, it's what I've said. So let's look at the specific types of asset misappropriation. Stealing of cash, cash theft. So this is physical stealing of cash or petty cash. Because cash is very troublesome. Yes. For some people, the reason why we put cash first is that for many people, if I put the chair I'm sitting on in my office, if I put it in a place where they can easily steal it, they may not be tempted to steal it. Cash, they will steal it even before I put it out. Okay, so cash theft is very common. under the asset misappropriation. Then we have fraudulent disbursement. That one may not be direct stealing of cash. They kind of devise some means which they use to steal the cash indirectly. For example, payment to ghost names. It's an example of fraudulent disbursement. Paying fictitious suppliers. Supplier behind is a Okay. So these are the forms that fraudulent disbursements take. We have inventory fraud. In addition to cash, some inventories are more susceptible to stealing than others anyway. So if let's say we are dealing with, the company is dealing with phones, and let's say it is Samsung and iPhones, the luxurious types. The tendency that employees will be stealing because it's just a pocket size something. You can easily slot it. The person will not even take it with a box. No, 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 that's dangerous. Yes. He removes that tiny thing from the box, puts it in his pocket straight. Yeah. So inventory fraud is also very high under assets misappropriation. And then misuse of assets. You can find it a lot in the public sector. An official car, then a driver used it to go and pick his or her, it is mostly his, because the men mostly drive. Pick his children from school, take his wife to the market, and other stuff. They are all fraud. They are all criminal. But it's like as if they have been legitimized in Africa. They are no more fraud. But once you are reading this under fraud, you have to be aware that they are fraud. Assets misuse or misuse of assets. So these are the specific things under assets misappropriation, the key things that you can find under assets misappropriation. And the last one is the last type of fraud is financial statement fraud, also referred to as fraudulent financial reporting, also referred to as creative accounting, also referred to as window dressing of accounts. These are some of the synonymous terms you can find around the same thing. It's just an attempt by the perpetrators of the fraud to actually show a better financial reporting than it actually is. Mostly that's what it is. So they kind of window dress. If the thing is, they kind of decorate the account, so to say. Apply cosmetics, like the women do a lot. I think women will be better in doing this kind of fraud than men, but they can decorate. Okay, that's about the third type of fraud, which is financial statement fraud. You can read in detail on each of these types. And this is an area that we don't have so much people in. So as accounting people who are aspiring to be accountants, who have that philosophy of going that way, it's a very lucrative area to go. This is just to whet your appetite. And please let me just say this in passing. We have been hearing the expression whet appetite, whet appetite. But okay, let me be frank with you. Not too long that I actually came to find the spelling of that word. From the beginning, I thought it was this word, W-E-T. How many of you think it is this word? Must I be frank, because me, I'm telling you, I thought it was this. Until recently, I got to know the real spelling. All of us. Is that what you're also thinking of the spelling?
Yeah, all of us.
Yeah.
No, sir.
Okay. Who said no, sir? So tell us. So what were you thinking of the spelling? Did you say no, sir, for the sake of saying no, sir? Okay, so let me proceed. Actually, the spelling is WHET. So please, it is not wet as in you have soaked something in water. This is the spelling. The white people, if we had invented English, we would have pronounced the second word actually wet to kind of make the H appear. But the typical English people in this pronunciation, you will not hear any H. Even in a spelling like this, Greenwich. I'm saying Greenwich because of where I come from. The typical English people will not pronounce the W. It's Greenwich. So when you go to Abuja and you are speaking, these things expose you. They know, oh, this guy is coming from here. It's Greenwich. So this is the wet. So whet your appetite. So what we are saying is largely to wet. This word actually means sharpen. Sharpen. It's like you are sharpening a cutlass. Wet. That's the word they use for. So I'm kind of sharpening your interest in it by this kind of lecture. The details, actually, most part of it needs to be done by you have to read beyond what we are doing. Okay. So let's look at the next thing on the presentation. Conducting investigation. Actually, we have even said everything about what goes on under the conduct of the investigation. It follows this process, very akin to, I mean, audit as we know it. Planning, evidence gathering, review, reporting. Okay, so that's basically the structure. It's just that the focus is a little bit different. This has a focus of unveiling a thief, actually determining the size of the theft, and doing a report which needs to be sent to the court as an evidence. That's the focus. Let's run through it. So the first process in the conduct of the investigation, forensic investigation, is accepting the investigation. Of course, you need to accept the investigation for there to be a contract between the auditor and the client. That one is automatic. And we know from all the things we have been learning, we know that something goes into the acceptance. You can't just go and accept. What if you are accepting your own death? So certain considerations must be done. You can find some of it inside the text, but you can think of more even beyond the text. At least one thing, the auditor needs to make sure that the work he's accepting is not beyond his capacity. He has the number, I mean, the quantity of workforce, the quality of them, the time, I mean, the expertise to carry out that job he's accepting. That's the key thing. The auditor also, beyond those capacity assessments, also needs to look at things like um, ethics, ethical considerations. Yeah, because this is largely audit. So you need to look at ethical consideration. Are you in some tight ethical situation that you cannot accept it, or you are cleared 100% of all ethical issues? When you consider these things, then you kind of know the position you have to go, whether to accept or to not accept. Then the next phase of the investigation process after the acceptance is It's planning the investigation. Because you accept to carry it out, so you have to plan how you do the execution. And the planning should involve things including these critical issues. Identifying the type of fraud, because we just discussed at least about three types of fraud. You need to know the type of fraud you are investigating to kind of understand what procedures, what techniques that you need to roll out there to bring out the required evidence. So identifying the type of fraud that has been operating, how long the fraud has been operating, and how the fraud has been concealed, the mechanisms. Identifying the fraudsters involved, quantifying the financial loss suffered by the client, gathering evidence to be used in the law courts, providing advice to prevent the occurrence of the fraud subsequently. So this is what typically goes into the planning stage. And you devise your evidence gathering procedures or techniques, and you roll them out to kind of fish for the evidence. And the evidence should be sufficient. That one, it's a must. To ultimately do the following things. One, identify the fraudsters, because that's the focus. The mechanisms or the mechanics that they use to perpetrate the fraud and the amount of financial loss involved. Your procedures will have that intent. So this will guide you the kind of procedure, the kind of testings you will have to do to get this, because that's what you want. So techniques like the following can be used in combinations. One thing is that most fraud issues come up because controls to actually prevent them or to alert us on their occurrence are weak, or they may not even be there. So the auditor has to gather the evidence through, first of all, by looking at controls. The auditor can test controls to gather evidence which identifies the weaknesses that allowed the fraud to be perpetrated. Simply speaking, what it means is that test controls for an understanding of why the fraud occurred, because it might be related to control failure. So when you test all the controls, you may come into contact with that failure, that part of the control system, which failed for the fraud to be perpetrated. The second thing that the auditor needs to do in the process of evidence gathering is to employ traditional auditing techniques such as analytical procedures, substantive procedures. The auditor can also use computer, because modern computing technologies offer smarter and more insightful ways to get evidence. Things like data mining, machine learning, and all those kind of things are deeply into auditing now. When we go to the last topic, which is about current developments or emerging issues in the area, we'll talk about some of these things. So these are some of the techniques that the auditor can employ in terms of gathering evidence. These are some of the procedures. So we've talked about acceptance as the first stage of the investigation process, planning the second, evidence gathering the third, and the next one is reporting. There was a contract between you as the auditor and the client is your boss. You need to report to him. He gave you the job. That's simply what it is. So I don't think I need to spend time to explain reporting. It's self-explanatory. Court proceedings. In most cases, the fraud investigations may proceed to court for final settlement. Court proceedings may be the last stage of the investigation process, the whole process of the forensic audit. So that's about that topic for now, for what you should know. I mean, no, that's just to whet your appetite, okay? So that's about forensic auditing and forensic accounting. The details of the techniques of fraud investigation is more than what we have said here. So you can be interested and be going deep into those areas. Any questions on forensic auditing? Silence means no question. So we can turn our attention to the next topic. The next topic is on prospective financial information. In short, PFI. We can have a gist of what this topic is about from the words that are forming the topic. Prospective. As accountants, we already know financial information. So what do you think prospective financial information is? It's quite understandable. Let me solicit for your knowledge, your understanding before we actually look at the details. Daniel Osei, if you are absent, I'm going to mark you as absent.
Yeah, I'm present.
Yeah, done.
Hello, sir.
Let's hear you on the issue.
Prospective financial information. In my knowledge is assumption about the future
Okay.
that relate to events and actions which have not yet occurred.
All right. Okay, that's good, Daniel. Who else wants to speak? But why do you wait for me to mention your names? I mean, this you should be speaking. Hey, level 400. Oh. Eric Adai or Eric Ade. Eric, if you don't respond, it means you are absent. Eric Adai. Eric is absent. Okay, noted. Evelyn Edu. Evelyn. Edu Evelyn.
Hello, sir. Hello, sir.
Yes, Evelyn. Let's hear you on the question.
Okay, sir. Please forgive my voice. I've lost my voice.
Oh, don't worry.
Um, Prospective financial information is the management. Is, hello, sir.
Yes, Evelyn, we are listening to you.
Please, is the management estimate of future results, and it's based on evidence, which is generally future-oriented and speculative in nature.
Okay, thank you.
Yeah.
Thank you all. Okay. Which tells me that we have generally gone through the text on that topic. But we should try to have a practical understanding of what we are reading. Otherwise, it will be like we are reproducing something we don't really understand. Okay. Prospective. What you said about it is 100% correct. It relates to the future. So it is futuristic thing. something yet to occur. Prospective. That's the meaning of prospective. So prospective financial statement, in simple terms, is financial statements whose content is produced based on things that are to happen in the future. They have not yet happened. Because the traditional financial statements, are historical. They carry information about things that have already happened, that have happened in the past. We yearn to know of the future, so we use prospective financial information as a mechanism to see the future. That's what prospective financial information is. And businesses prepare prospective financial information mostly for two purposes. When in their prospectus to potential investors, when they are probably soliciting for money from investors during security offering, they will put in the prospectus prospective financial information, which gives a sense of what investors should expect in the future. Mostly, I think it will be a prospective financial information, which is showing a good picture about the organization. So that's one main area that prospective financial information is prepared. Another area is to be published in um, published financial statements, the audited one, the final one, which is circulated to shareholders, to all users for their use for decision making. So when you take any published financial statement, I mean, listed companies are by law required to publish their statements, their financial statements every year. So when you pick any one of them, you will see a section on prospective financial statements. So these are the two situations mainly where you will find prospective financial statements. So now let's try to go into the details. This is just the overview. The explanation we gave about prospective financial information, the definition, is correct. You can read the details of the information for more details, but try to understand it practically. You don't need to actually um, use some, I mean, you don't need to strictly use the words in the text I've given you. You read, I'm explaining something with my own words. When you understand what I've explained, you can explain the same thing with your own words. That's how learning is done. That's what learning is. But if you tell me something that I have said in my own words, first of all, it communicates you don't really understand it. And of course, you don't. Otherwise, you would have used your own words. So let's learn it the right way. Prospective financial information can be, they come in two main types. It can be a forecast. So I'm kind of talking from here. Types of prospective financial information. Two main types: forecast and projection. They are all information prepared on the basis of what is expected in the future. But the first one, forecast, is actually based on management's best estimate of what is likely to happen in the future. So it is prepared on the basis of what they call best estimate assumptions. And what will make you understand it better is that It is prepared on the basis of actual data, not fictitious data. Data sets that gives us a sense of what will happen in the future. So it's maybe prepared on the basis of what has been happening to our company over the past years. So the sales trends over the past years can be used as the basis of inferring the sales that we should expect in the future. The expenses, the same way, all the elements in the financial statement, the same way. In addition to past trends in our transactions, we also we analyze what is currently happening and how it affects what the past has told us. Mainly, these two things inform our expectations of the future. So these assumptions from these sources is what we term as best estimate assumptions. That's what we call forecast. That's one type of prospective financial information. The other type is more of what if scenario. The what if scenario is, for example, if I'm trying to do some model. Okay, um, this is our selling price per unit, and then it's generated as this total sales revenue. What if selling price per unit is not 200 but 150? What if we reduce? Okay, so the kind of situation you will get. Okay, it's also a prospective financial information. So that's what the projection type of prospective financial information is. A projection means prospective financial information prepared on the basis of one or more hypothetical, but it must be realistic. Even though hypothetical, it shouldn't be just foolish guess. It must be realistic, but it is hypothetical. The forecast one is normally informed from real data, not hypothetical data. Like I told you of past sales trend, it's not hypothetical data. They are data that have actually occurred. How that data is shaped by current development, that is not hypothetical. It is something that is happening now. Okay, so that's the key difference between the two PFIs. The standard that talks about how the auditor should do his work on PFI is called International Standard on Assurance Engagement 3400, ISAE 3400. In fact, you can Google right now, ISAE 3400, and it is free. So it's an assignment I'm giving you. Everybody should Google and download ISAE 3400 and read the full content. It's few pages. And I'll call you unaware for demonstration in class. And it's going to form part of our continuous assessment. Already we don't have continuous assessment. I don't even know how I can do quiz. So this gives me an opportunity. So go and download ISAE 3400. Even though we'll be talking in more summarized and practical perspective about ISAE 3400, it's your duty as an accounting student to get that standard and read it. And in fact, if you don't do that, it's a choice because it is free and it is just right in your palm. Okay. So these are the key things that the standard is saying about what the auditor is supposed to do around prospective financial information. When the auditor is given an engagement to audit prospective financial information, what should the auditor do? First of all, we have the understanding that prospective financial information is not information that has actually occurred. It may occur or it may not occur at all. So the way the auditor will do audits of this will be different. The opinion that the auditor will express will be different. And the level of confidence that the auditor will have to give to the users will be different. We have to have this right from the beginning. So these are the things, specific things the auditor should be doing in obtaining evidence regarding the free and fairness of the PFI. Remember that we cannot say that the PFI is true and fair. I'm just using the concept of free and fair in quotation marks because these are highly things on assumptions, and your description of them as true and fair is quite subjective. Okay, so let me just borrow the word in a loose form. What the auditor is to do to actually substantiate that the PFI is to, I mean, to a large extent, is correct. Is, I mean, maybe correct is, I can't use correct in that hard sense. It's okay. The standard guides the auditor in these ways. The auditor should gather evidence to substantiate that the assumptions on which the PFI is prepared is reasonable and not unreasonable. It is the assumptions that tell us how realistic or how correct in quotes, the PFI is. But if you can really assess the assumptions and come to the determination that the assumptions are good, they are realistic, then you need to understand. You need to have a very good knowledge about the business for you to know that, okay, this assumption that they have provided as a basis of estimating this makes sense. If you don't understand the business and its operations, then you cannot judge the reasonableness of the assumptions. So the auditor's work requires, and as for that one, the auditor is aware. You remember when we were even doing planning and risk assessment, the auditor is to gain knowledge of the risk or the risks the client is in by understanding the client and the client's operating environment. Same thing applies here. If you can judge the reasonableness of the assumptions, you have to, first of all, you have to get good knowledge in the business and its operations. The second thing the auditor needs to do is to actually look at the PFI preparation process of the client, the systems through which the PFIs come out. You have to subject that whole process or system into tests, into investigation. If the process is good, then its outcome can be expected to be good as well. That's the main objective. The internal controls, when we're talking about systems or the process, of course, we cannot rule out internal control. And internal controls inside the whole process or system that produces the PFI. The auditor is supposed to investigate the internal control for its um, completeness, for its effectiveness. Then that gives the auditor knowledge about whether the PFI is likely to be correct in quote, or not correct. Apart from the internal controls, the auditor should also look at the nature of the documentation prepared by the entity supporting management assumptions, the full details of the assumptions, the extent to which statistical, mathematical, and computer-assisted techniques are used in the whole process of the PFI preparation, the methods used to develop and apply assumptions. The auditor needs to interrogate them for their reasonableness or otherwise. The accuracy of prospective financial information prepared in prior periods. That one can give us a sense of how likely this one is also to be good or bad. If previous ones they have done has been correct, then it can give us the expectation that what they are currently doing is correct. Or it can also give us information about, of course, if they've already been preparing PFIs. Let's say they've prepared PFI for the last year. They did it last year, and they have done it this year. We do not expect so much difference between the way they will do it this year from last year. So much difference between this year and last year. We do not expect so much variations. Okay, so that's some form of analytical review with the intent of judging whether this PFI you are looking at is correct or not. So if you judge the process, your final assessment comes to the determination that the whole process of the PFI preparation is porous. Of course, we know what the auditor will be thinking in terms of the opinion to express, and vice versa. Still substantiating the reasonableness of the assumptions under which the PFI is prepared, other considerations such as the following can be looked at. I will just brush over them because you can read the details. The fact that assumptions often have interrelatedness among themselves. The auditor needs to be aware of that fact, that different assumptions usually have relationship with themselves. For example, the assumption that sales revenue will increase in the future naturally should also come with the assumption that expenses that were incurred to generate that revenue, or expenses that will be incurred to generate that revenue, will also have to increase in the same direction. It is not too reasonable to have an assumption which says sales revenue will increase in the future. And then the assumption for cost of sales is that cost of sales will be the same or cost of sales will reduce. It's not realistic. Because after all, the increment in the sales revenue will come in the form of increment in goods produced or increment in goods available for sale. But wouldn't you use money to buy them? Isn't those things expenses? You will have to probably hire more people into the production, buy raw materials, and so on and so forth. So it will naturally step up the cost. This is too easy to speak, to actually pick. Some interrelatedness may not be this obvious, but it's still the duty of the auditor to understand the fact that assumptions have interrelationships, and the assumptions document that the client has provided have everything intact in terms of these interrelatedness. Otherwise, there is something wrong. Auditors should also be aware of the fact that you cannot have assumptions that is pointing to the north, and then your business strategy, your mission, your vision, and other things also pointing to another direction. No, there should be a sync between the assumptions and the strategic plan, the mission, the vision, everything. There should be that sync. There should be that correlation. It should naturally flow from these strategic plans, which requires the auditor, like we said before, to be very knowledgeable about the business he's auditing. If the auditor is very knowledgeable in that way, the auditor understands the strategic plans of the business, the mission, the visions, and all those stuff. So the auditor will be able to determine that these assumptions you've provided in the assumptions document is a variance with your strategic plan, or they are in conformity, before you can come up with a valid opinion about whether the PFI is good or is not good. Consideration number C is the assumption should be supportable. To be supportable, best estimate assumptions need to be based on past performance. I've already spoken these things. That's for forecast. So the fact that, okay, our assumption about this level of sales is supported by trend analysis of our past sales records, our analysis and understanding of how the economy in general, how our industry is doing. Yes, that is supportable. Okay, so basically that's what it is. So we've talked about the auditor assessing or determining the reasonableness of the assumptions. Very much related to that one is the auditor having a good understanding of the process or the system through which the entity publishes or prepares the PFI. And much inside that area will have to do with controls. The third one is the prospective financial information is properly prepared on the basis of the assumption. That is another thing the auditor needs to determine. Well, assumptions. That's the first one. Reasonable or not. Let's say it passed the reasonableness check. So the auditor concluded that, oh, the assumptions are reasonable against the strategic plan and everything. The assumptions are okay. The next big determination is the PFI as you have before you as the auditor. Is it prepared on the basis of that or those assumptions that you have validated? Because it is not surprising that they can have some nice assumptions. Probably they even copied it from somewhere. Everything is relating well, well, well. Only for you to realize that, oh, the assumptions are one thing and the PFI themselves are another thing. You need to check whether they have actually prepared a PFI on the basis of those assumptions you have checked to be correct. Or the assumptions are something else and the PFI is doing its own kind of thing. The auditor needs to do that determination. And we know what the auditor's opinion will be depending on whether he judges it to be prepared on the basis of the assumptions or not. For the prospective financial information, the auditor needs to determine that the prospective financial information is properly presented. Presentation is very important. And as accountants, I don't need to bore you with the details of presentation. But let me speak these few things. Proper presentation requires that prospective financial information shall be labeled clearly as either a forecast or a projection. That's very important so that it doesn't become deceptive to users. But most importantly for accountants, There should be full disclosure of all the assumptions. That's part of the presentation. The auditor should also check that the following disclosures have been made. Apart from general disclosure, this specific disclosure, the date of adoption of the underlying assumptions. Because the assumptions they hold within a space, a range of time. The assumptions may hold within a bracket of time. So outside that bracket, they may not hold. So we need to know of the date of the adoption of the underlying assumptions and how long they will hold valid. The extent to which actual financial results are incorporated and other things. All of these things are disclosure issues. And then 5, last one, about what the auditor should do concerning PFI. The auditor should make sure that the prospective financial information is prepared on a consistent basis with historical financial statements. In fact, the fashion is the same as your historical financial statement. The only difference is that this is into the future. So the style, the format, everything should be very much consistent with your historical financial statement. And the editor needs to kind of investigate to come to the determination that this is the case or otherwise. So these are the broader issues inside audit of prospective financial information. These are the things that the auditor needs to subject under investigation, gather evidence on them, gather sufficient and appropriate evidence on them as the basis of expressing whether the prospective financial information is good or it's not good. Please, any question? But read on ISAE 3400. It's a small document, it's free, it's just right in your palm now. Immediately after the lecture, you can download it. Don't make it tomorrow, you will forget. Download it right after the lecture and read through it today. Yes, briskly read through it from head to toe. Don't pay so much attention. Just your focus should be to read it totally from beginning to end, to have the broader idea of what the standard is speaking, in addition to what we have already explained. And then you find time to actually go through it to pick the details. That's what good students do. Okay, so any questions?
No questions, sir.
That's you, right? But you can't know whether the whole class will not have question. So he doesn't have a question. He spoke for himself.
No questions, sir.
Okay, no question. Okay, so officially this is where we end the lecture. And thank you very much for your attention.